Let's get right to it. PepsiCo drops its latest earnings. They beat on earnings per share, they beat on revenue. Then they announce a colossal $10 billion stock buyback, and they hike the dividend for good measure. I mean, on paper, that's a grand slam. But what happens? The very same day, the stock drops 1.5%. Now, something there just doesn't add up. Welcome to Iron Financial. This is the place where we don't just skim the headlines. No, we take a sledgehammer to the foundation, and we stress test the market's biggest names to see if they'll crack under real pressure. Today, that name is PepsiCo. Let's get to work.
Okay, so before we start swinging that sledgehammer, let's lay out the plan. We need to understand the official story management is trying to sell everyone. So here's our plan of attack for today. First, we're going to start with the thing that forced their hand in the first place, the intense activist pressure. Then we'll break down the new turnaround blueprint they've drawn up, their supposed master plan for the future. After that, we're going to put that blueprint to its very first real-world test, and that's the latest Q4 earnings report. From there, we'll start digging. We're going to go searching for the structural cracks that the market is clearly seeing, the things that, don't quite make it into the shiny press release. And finally, we will deliver our verdict. Is PepsiCo actually building a fortress for future growth, or is this whole thing just a value trap designed to catch unsuspecting investors?
All right, let's set the stage here. PepsiCo is a $200 billion corporate titan. I mean, it is an absolute giant in the industry. But even giants can show signs of wear and tear. And when they do, when there's even a hint of weakness, well, that's like blood in the water. It attracts predators. And in this particular case, the predator that came circling was an activist investor who saw a golden opportunity to force a change and unlock a whole lot of value that they believed current management was just leaving on the table.
Yeah, and let's be really clear about what that weakness actually looked like. I mean, we're not talking about superficial scratches here. These were deep, serious cracks forming in the company's armor. The data on this slide, which comes straight from Guru Focus, is pretty damning when you look at it. Operating margin, that's a key measure of how profitable a company is, has been in a steady, relentless 5-year decline. We're talking about an average drop of 1.6% every single year for 5 years. That's not a paper cut, that's a structural bleed. And the very core of their business, the PepsiCo Foods North America division, that's your Lay's, Doritos, Cheetos, the whole shebang, it was lagging, badly. They were losing ground, ceding precious market share to hungrier competitors. This wasn't just some temporary slump, this was a dangerous trend. And in this market, what does a trend like that get you? It gets you a giant target on your back.
Precisely. And the predator that smelled that blood in the water was none other than Elliott Investment Management, one of the most aggressive and formidable activist funds on the entire planet. They took a massive position, and they forced a sit-down with management. Now, this quote you see here from Elliott's partner, Mark Steinberg, it's taken directly from the 8K filing, and it tells you everything you need to know. He says they appreciate our collaborative engagement. Now, let me translate that for you. In Wall Street speak, that is the polite, public-facing way of saying, we showed up at your doorstep, we laid out our non-negotiable demands, and you really had no choice but to listen. And that word he uses, urgency, that's the key right there. Elliott lit a fire under a management team that the rest of the market felt was getting slow and complacent.
Right, and for anyone who might be new to this game, let's be crystal clear on what an activist investor really is. This isn't just some big mutual fund buying a bunch of shares for a passive investment. Oh no. An activist like Elliott buys a massive stake for one reason and one reason only, to get a seat at the table and to force change. They don't just make suggestions, they make demands. They show up with their own army of analysts, their own data, their own plan, and they basically tell the company how it's going to be run from now on. In this case, Elliott wasn't just asking for a new coat of paint on the building, they were demanding the whole thing be torn down to the studs and rebuilt from scratch according to their blueprint.
Which brings us right to management's response. Because when you have a fund like Elliott breathing down your neck, you don't have a choice. Under immense pressure, PepsiCo's board and its leadership team had to act, and they had to act fast. They released this new strategic plan, filed it with the SEC on December 8th. This is it. This is the official blueprint for how they say they're going to rebuild, how they're going to reinforce the structure, and how they're going to get this giant ship back to a state of growth. This is their new battle plan.
Okay, so let's really dive into this plan. It's built on 3 core pillars, 3 main ideas. Pillar number 1, sharpen value. So what's that mean? Well, it means getting a lot smarter on pricing, creating more affordable options to win back consumers who are probably feeling the squeeze from inflation and are maybe trading down to cheaper store brands. Pillar number 2, elevate innovation. Now, this is about more than just a new flavor of chips. It's about what they call permissible and functional snacks. Things with simpler ingredients, maybe more protein, stuff that aligns with all the modern health trends you hear about. And then there's pillar number 3, reduce costs. And believe me, this is the big one. This is a promise for an aggressive, no-holds-barred push to slash operating expenses and make the entire corporate machine more efficient. Look, on paper, it's a solid logical framework.
Right, on paper are the two key words there. So what does all this corporate speak actually mean in the real world? What are they doing? Well, it means they're shuttering 3 entire manufacturing plants. It means they're shutting down several specific production lines. They're cutting nearly 20% of their product variations, that's SKUs, in the US market. And on that innovation front, they're launching so-called Simply Naked Cheetos and Doritos, and apparently a Doritos protein chip is coming down the pipeline for 2026. Well, look, these are decisive, necessary steps. You have to streamline the business. You've got to cut the fat before you can build new muscle. Decisive, or is it desperate? Is this really the kind of heavy lifting that's required to reverse a 5-year structural decline in margins? I mean, closing a few plants is one thing, but are new versions of Doritos and Cheetos really going to be the engine that rebuilds this corporate giant? I'm not so sure.
Well, whether you're sure or not, the market now has a very clear benchmark to measure them against. Management absolutely put their reputation on the line with this. They are officially projecting a return to significant growth in 2026. Specifically, they're targeting 7 to 9% core earnings per share growth and this is crucial, a full 100 basis points, that's 1 entire percentage point, of margin expansion. These are not soft targets. These are hard, specific numbers that they will be held to. The entire success or failure of this new blueprint, this whole turnaround story, it's all going to be measured against these specific goals.
And you know what? We didn't have to wait very long for the very first test of this new plan. The Q4 earnings report, which came out on February 3rd, was the first real dispatch from the front lines. It was the first chance for the market to actually see if all this new urgency was translating into real, tangible results. And well, let's just say the market's grade was not what management was hoping for. The initial reaction was to sell. Let's find out why.
All right, so let's start with the headline numbers, because if you just glance at them, they look strong. First up, earnings per share, or EPS. The consensus on Wall Street, the average expectation, was for $2.24. PepsiCo came in and delivered $2.26. That's a beat, it's a clear win. So let's check that box.
Okay, next, let's look at the top line, revenue. The street was expecting about $28.96 billion. PepsiCo came in at $29.34 billion. That is a beat of nearly $400 million. Let me be clear, that is not a small number. That is a significant beat. It suggests that overall demand is pretty resilient and that, their products are still selling. So again, on the surface, this looks like another solid win for the company.
And right here, this is the central paradox of this whole situation. This is the big question at the heart of our analysis today. They beat on earnings, they beat on revenue, they went and raised their dividend by 4%, they announced a new $10 billion share buyback program. Every single one of those announcements should, in a normal world, send a stock higher. It is exactly the kind of news that CEOs dream of delivering. So why? Why did the professional traders, the big funds, the ones who actually move the markets, why did they look at all of this good news and immediately hit the sell button? What did they see that the headlines missed?
Here's your answer. This one slide tells the whole story. You have to be willing to dig one level deeper into the earnings report. You have to go past the headlines and look at the organic sales growth broken down by division. So while Europe and the Middle East, they held up okay with 5% growth, and the North American beverage business was basically treading water at plus 1%, look at that last bar. PepsiCo Foods North America, the crown jewel, the most important division, the very division this entire turnaround plan is supposed to fix. It shrank. It actually posted negative 1% organic sales growth. Is it because consumers are trading down? Maybe. Are competitors' products simply better or cheaper? Possible. Or is this an internal execution problem? You know what? It doesn't matter. All the cost-cutting talk in the world is just noise if you can't sell more chips and snacks in your most important market. This is the crack that spooked the market.
Exactly right. That one little number, negative 1%, it calls the entire turnaround narrative into question. And it tells us we need to go deeper than just one quarter's results. It is time to get out the tools and conduct a full stress test of this company's financial foundation. We're going way beyond the press release now, and we're searching for any other structural cracks that could threaten this turnaround before it even gets off the ground.
Okay, let's lay the key metrics from Guru Focus out on the table for a full health check. The operating margin is sitting at 13.2%. Now, as we've established, it is in a 5-year decline, and that is the central problem they absolutely need to fix. I see that as the core focus of the new plan. It's a known problem, and they have a proposed solution. A proposed solution, but I see a problem they haven't proven they can actually fix. It's a structural decline, not a blip. And you know what that problem leads to? The next one on the list, a dividend payout ratio of 0.75. That means they are paying out 75% of their profits just to cover their dividend. That's a sign of their long-term commitment to their shareholders. Or it's a sign of a company with zero room for error. If their earnings dip even slightly, they either have to cut the dividend, which the market would absolutely crucify them for, or they have to borrow money to pay it. That is not sustainable. And then look at the valuation, a PE ratio near its 2-year high. So you're telling me you're supposed to pay a premium price for a company with declining margins and a risky payout ratio? Investors are paying that premium because they believe in the power of the brand and they believe in the turnaround story. They're betting on the future. They're betting on a future that just started with a negative sign. Look at that last line item. To me, it's the most damning number on this entire page. The actual volume, the number of bags of chips sold of convenient foods dropped 2%. People are buying fewer bags of Doritos. That is a fundamental demand issue. That is not just a pricing problem. That, my friend, is a serious structural crack.
Look, I hear all the concerns about demand and margins, but we have to maintain perspective. This is not a company that is on the verge of collapse. We have to look at the overall structural integrity of the business, and the Altman Z-score is one of the best tools we have for that. It measures a company's financial health by looking at 5 key financial ratios, things like profitability, leverage, liquidity, and it uses them to predict the likelihood of bankruptcy. Now, any score over 3 is considered safe, in no danger. PepsiCo's score is 3.55. What this tells us is that despite the margin pressure and the recent volume dip, the core financial structure of this company is a fortress. The balance sheet is solid. They have the financial firepower and the stability to execute their plan. They are not in any financial distress.
All right, we have examined the pressure from the outside. We have analyzed the blueprint from the inside, and we have stress-tested the first results from the real world. We've seen the good, we've seen the bad, and we have definitely seen the ugly. So now it is time to bring all of that evidence to the table and weigh the two opposing cases. It is time for the verdict. Is PepsiCo a fortress being reinforced for a stronger future, or is it a trap just waiting to spring on unwary investors?
The bull case, my case, is that what you are looking at is a fortress that's currently under renovation. You have the powerful catalyst of activist pressure from Elliott, which ensures that management stays focused and urgent. You have a clear, logical, 3-pillar plan that is designed to address the very weaknesses that the market has identified. The latest earnings report, despite all the noise, still showed headline beats on both the top and the bottom lines. They are returning a torrent of cash to shareholders, which shows real confidence in their future, and underpinning all of it is that rock-solid balance sheet confirmed by the strong Altman Z-score. They have the plan, they have the pressure, and they have the financial strengths to get this job done. And the bear case, the trap, is that you're looking at a beautifully painted facade on a crumbling structure. The market, the smart money, is screaming that something is wrong when it sells off a stock on good news. It sees that the core U.S. Foods division, the very engine of this whole company, is not just sputtering, it is actively shrinking. It sees that margins aren't just down for a single quarter, they are in a 5-year structural decline that a new protein ship is probably not going to reverse. It sees a risky dividend payout and a stock that is priced for perfection at a time when its performance is anything but. You are being asked to pay a premium for a fixer-upper, and the foundation is showing some very serious cracks. So here's where we leave you. Management has the blueprint in hand. Elliott Investment Management is acting as the foreman on the job site, making sure they stick to it. But you know, all the plans in the world don't matter if the foundation you're building on is faulty. At Iron Financial, our job is to give you the tools to do your own stress test. We've shown you where the strengths are, and we've pointed our flashlight directly at the cracks. Now, it's your call. Is this a foundation strong enough to build a fortune on, or is it a trap that's just waiting to crumble under the weight of its own problems?